You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and your author of the Options Playbook. Well, last week we took a little break to chat, and the week before that, we talked about two trades around earnings, and I'm just going to recap those trades. We looked at Pepsi. Actually, Pepsi was talked about 2 weeks in a row. And that's PepsiCo, if you want me to be technically correct. Symbol is PEP. And we looked at doing a diagonal in Pepsi. And we talked about why we wanted to do the trade and everything that we went through. Now, always meant to be a paper trade and a learning experience. But Pepsi was very interesting in that we sold the shortest term expiration with only 1 day remaining, 116 call, and then we bought the next expiration out a week later, 117 call. And I just want to recap what happened with Pepsi on that trade. So Pepsi, the day before earnings, the day of earnings, I should say, closed at 112.59, and it actually opened up at 115.85. So I don't know if you could get a better opening price. Traded down a little bit, down to 114, and closed at 115.91, 10 cents below our short strike. So many opportunities to get out of that as a profitable trade. You might even stuck around. At one point, it did go above 116 to 116.28, which means our short option was a little bit in the money. But we said that, well, if you had a position on, let's say we had 10 or more contracts, I would have wanted to close it out on the open and get whatever you could out of the trade, because the implied volatility should have came in and the front month should have collapsed on us because it wasn't in the money on the open. And that's all that we're really shooting for on the diagonal. And an ideal scenario, if you wanted to stick around, would be close half the position and then let the other half ride and see what happened the following week, because you basically had a call option that you didn't pay for, right? You brought in a net credit on that diagonal trade. And so you received a net credit for putting it on, and you could have sold to close the position. I should say just close the position, because you'd be buying one option, selling the other option. And you could have closed that position for also a net credit to the account. So on Options Playbook Radio, we always just want to talk about conditions that are right for these strategies. We don't really like to pick any underlines or make any forecasts. Pepsi was a very interesting trade. And then we also brought up NVIDIA. NVIDIA, we were looking for a 10-point expected move after earnings, and we did a ratio butterfly, sometimes referred to as a Christmas tree butterfly. It wasn't an exact Christmas tree butterfly, but we did that entire trade for a net credit of 20 cents to the account, because we did it as a 1/3/2 ratio spread. So net credit to the account of 20 cents. We had 2.5 points of risk. we were thinking that based off of the expected move, NVIDIA would open around between 10.5, 11 points. Guess what? NVIDIA opened exactly that. So the strike that we wanted it to get to was 167.50. We went a little bit farther out of the money because we're a little scared about NVIDIA. Still got a net credit of 20 cents. Stock opened at 162.95, went to 163.87 on the high, and then actually closed at 157.34. So traded all around that strike, many opportunities to get out, probably higher than the 20-cent credit we received as on the open, because I'm sure it took a while for some of the premium to come out of a stock like NVIDIA. But bottom line is that one should have turned out just fine too. Even if you did absolutely nothing, all the options would have expired worthless and you would have received the net credit of 20 cents. So 2 fun recaps to talk about. So let's go back, and we did all right with the diagonal spread on Pepsi. Earnings are still hanging. There's still a few around. And one of the biggest things about these stocks is I like earnings, or talk about earnings, on more expensive stocks, because you can get more creative with the option strategies. So guess what? We have Costco announcing on Thursday after the close, which means I need to mention that we are taping Options Playbook Radio on the 27th of February, and the markets are closed right now. So they're going to be announcing after the close tomorrow, based off of when we're taping this. And Costco is a $218 stock. It actually closed at $218.05, up 44 cents on the day. So let's rinse and repeat. We had a diagonal spread. We've talked a lot about skip strike butterflies. We looked at a ratio, quote unquote, Christmas tree butterfly last week. Let's look at the Costco trade. So if we're going to look at anything around earnings, and once again, not meant to be a recommendation, we're just trying to learn how to set up a trade based off of what the option pricing is. So with Costco, the expected move on the $218 stock at this point in time is plus or minus 9. Now, once again, expected move is just what the long straddle is on the most at the money option contract. And I'm just going to round off to $9 because it's not an exact science by any means. And it never, ever points to a direction. We're just saying the marketplace is saying the long straddle is worth this, which kind of implies the market after earnings could move plus 9 points or minus 9 points. That would be the expected move based off of what the option volume is telling you, or the option marketplace. So with that said, with the stock at 118, we're going to try selling the front month that only has 1 day to live. And that's the key in this diagonal strategy that we've recently done in Pepsi, is that if they announce on Monday, the option lives too long. So we really want stocks that are going to be announcing earnings on Thursday after the close or Friday before the open, so that we have a short option contract that just has 1 day to live. And what we're hoping for is that it doesn't move more than the expected move. That's your whole premise of doing this diagonal spread around earnings. And we have that had that same situation in Pepsi in $110 stock, basically. And now we have it in a $218 stock in a stock like Costco. And one of the things that I do like we don't really make forecasts on the underlying, but I would rather be in Costco or Pepsi as opposed to NVIDIA, for example, when I'm looking at doing these type of trades, because just the sheer volatility of that underlying stock is a lot less crazy, if you will. Never know what's going to happen around earnings, but I don't want to do these in Amazon. I don't want to do it in Tesla, because these huge gap openings is what your biggest concern is. And those are stocks that you see more gap openings than the former mentioned Costco and Pepsi. All right, so let's set up the trade. So Costco, we're looking at a diagonal spread in Costco. We're going to have a margin requirement, and we're going to try to get this trade done for a net credit to the account. Costco, today on the 27th of February, a Wednesday after the market closed, last traded at $218.05. So we're going to sell to open the March 8th expiration 227.50 call. That means it's only going to have 1 day to live after the earnings report. And then we're going to go out to the March 15th expiration, which is 1 week away, and buy the next strike up, the 230 call. And we're going to do this for a net credit of 22 cents to the account. And we're going to do this for a net credit of 22 cents to the account. Now, that's the midpoint. You're going to hope that you can get that midpoint, but this is a fairly liquid underlying, and that's what your goal is, but there's never a guarantee that you're going to get the midpoint. And normally you would wait till closer to the earnings report. We're taping this on Wednesday. They're announcing Thursday after the close, so you'd want to look at the same type of scenario a little closer to the actual close of the market before that earnings forecast. So why did we pick the 227.50 strike? Well, the expected move in this case is 9 points. You add 9 points to 218, you come up with 227, which means we're a little bit farther than the expected move, which is a great goal. And then we want to look for an option contract that the shorter term option will pay for, and that's one strike up, the 230 strike. And we can get this whole thing done for a net credit of 22 cents to the account. Now, with that said, the width of the strike is the risk here. So you have a $2.50 width between the option that you're selling, the strike of the option that you're selling, and the strike of the option that you're buying. So that's going to be your risk requirement. That's going to be held out $250 for every 1-by-1 spread that you do. But you're bringing in 22 cents if you get a very good fill on the midpoint, which means your actual risk is $2.28. So what can happen here? What do we want to happen, more importantly? The perfect scenario is basically what happened in Pepsi. You would like it to open a little bit up, trade fairly close to the short strike, but then expire worthless, leaving you long an option contract for a week if you choose to not close it out. And that week, you have just the long option contract that you didn't pay for. You brought in a net credit of 22 cents to the account. The front month is doing a lot of the work here. It's paying for your longer term option contract. And in that scenario, you can either, if it opens just a little bit, to the upside, to the direction that you really kind of want it to, then you could close out the entire trade, or you could hope that this short option contract expires worthless, and then you decide when to close out the long option contract. Other scenario that could happen to the good is the market could just open down. If the market opens down, both option contracts will more than likely expire worthless, especially if it opened down the expected move, and you'd receive the net credit of 22 cents to your account. Now, what's the worst case scenario? Worst case scenario is that it opens up and it gaps double the expected move, just to pick a number, 18 points. Well, in that instance, the front month is going to go against you extremely hard because it's a short-term in-the-money option contract. It's going to have a lot of gamma. The delta is going to go to 1 right away. And the maximum you could lose then in that scenario is the total risk of $2.28. But if the only way that scenario really kind of gets to you is if the market gaps open a lot, right? It needs to gap open more than that expected move. Now, can that happen after earnings? Of course it can. And in many stocks, it has, where it's gapped open 1.5 times the expected move. It just happens. So that's where your risk is at. But you have 3 different scenarios that can work in your favor. You could have it open a little bit. If it opens just a little bit, half the expected move, or even the expected move, you're safe in this scenario relative. If it opens flat, that's not a bad situation for you either. And if it opens down, well, that is also an okay scenario in this trade. The only thing that really can nip you is a big move, and specifically a big move on the gap open. So let's recap our diagonal trade. We're going to do a rinse and repeat of the PepsiCo trade that we did a few weeks back. And we're going to look to go out with Costco announcing earnings on Thursday the 28th after the close. Right now, it's Wednesday the 27th. Costco closed at 218.05, up 44 cents on the day. we are looking to sell one March 8th, 2019, 2750 call, and at the same time buy one March 15th, 2030 call. And we're looking to do this at net credit to the account of 22 cents. Total risk to the trade is $2.28. And as always, whenever you're doing these type of trades, you want to remember commissions, especially on multiple leg trades, because there's a lot of commissions. And as always, this is just a learning experience. So please just do this on paper, follow the trade, see if you can pick something up. And that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.